Ever since Bitcoin first pierced its previous all-time high, the crypto world has been locked in a perpetual game of cat and mouse waiting, watching, wagering on the next breakout. As of noon on June 30th, 2025, BTC hovers around $107,000, teetering just above the $104,000 support level that has held firm through a week of violent swings and multi-million-dollar liquidations. But we all know that price alone tells only half the story. To mount a genuine assault on its ceiling and perhaps eclipse $120,000 or beyond before the final quarter of 2025, Bitcoin must marshal an array of converging forces. Technical catalysts, renewed on-chain vigor, a friendlier macroeconomic backdrop, and the collective conviction of both long-term and short-term holders. In this deep dive, we'll dissect each of these pillars through the lens of economic giants from Milton Friedman's monetary theory and John Maynard Keynes's animal spirits, to Nassim Taleb's anti-fragility and Mariana Mazzucato's vision of public-private synergy to map out exactly what it will take for BTC to rewrite its price history. 1. Technical, breaking the downtrend channel. On the 4-hour chart, Bitcoin is trapped inside a descending channel whose upper boundary sits near $109,000. Every rally bumps into that invisible ceiling. Every sell-off finds rest near $103,400, $104,600, a zone where the daily fair value gap and the 200-day EMA converge to form a magnet for liquidity. To flip from range-bound boredom into breakout euphoria, BTC needs a clean, decisive close above $109,000. Liquidity grab and stop runs. As Joseph Schumpeter might remind us, market progress often comes through creative destruction. A burst above $109,000 would trigger cascading buy stops, flushing out weak hands and re-energizing momentum. Volatility contraction, then explosion. Daniel Kahneman's work on loss aversion tells us that traders hate left-tail risk. A sustained move beyond that downtrend line would shrink perceived risk, draw in fresh capital, and set the stage for a volatility expansion one that could carry BTC rapidly toward the next supply cluster at $115,000. Chart psychology. Thomas Piketty argues that once a price barrier falls, it collapses under its own weight. Surpassing $109,000 would transform it from resistance into support, reshaping market psychology and unleashing a virtuous feedback loop of FOMO, fear of missing out. But breaking this technical straitjacket won't happen if the rally lacks conviction. We need daily closes above $109,000, rise in volume, and a retest and hold at the old resistance. Only then can chartists and algorithmic funds alike join the charge. 2. On-chain health, from dormancy to activity. If charts are the X-ray of trader psychology, on-chain metrics are the heartbeat of network health. Over the past 24 hours, Glassnode reports $28.6 million in long liquidations and $25.2 million in shorts, resetting leveraged positions and reminding us of Bitcoin's propensity for violent stop hunts. Open interest has slipped 7% from 360,000 BTC to 334,000 BTC, reflecting traders' caution. Yet beneath this churning lies a deeper story: declining profitability metrics. With the market stuck sideways, realized profit indicators have drifted lower. As Keynes would observe, animal spirits, that visceral urge to engage in speculative ventures, are subdued when the outlook is unclear. User participation at a lull. CryptoQuant shows that active addresses and transaction counts have flattened. Economists like Angus Deaton emphasize that real adoption and network effects underpin true sustained growth. A revival in on-chain use, be it through new applications, DeFi flows, or retail sending volumes, would inject fresh demand. The fair value gap as springboard. Mariana Mazzucato reminds us that innovation often springs from the cracks of market gaps. The $103,400, $104,600 zone is not just support, it's a potential launch pad. If miners and long-term hodlers consolidate their positions here, they can absorb selling pressure and set the stage for new entrants to swoop in higher. In short, Bitcoin needs its on-chain lifeblood to surge. Metrics to watch. Weekly active addresses, number of large transactions greater than 100 BTC. Total value locked in DeFi protocols, and percent of supply dormant for 1 year that reactivates. When these metrics turn green, it will signal that network usage and thus organic demand is reviving. 3. Macroeconomics. A friendlier Fed. No Bitcoin analysis is complete without accounting for the Federal Reserve. Rumors of an imminent rate cut have been swirling, but fresh inflation readings tell a different story. The PCE index climbed 2.3% year-on-year, while core PCE hit 2.7%, slightly above expectations and marking the first uptick since February 2025. Jerome Powell and his colleagues have been clear: until inflation moves decisively toward the 2% target, they will err on the side of vigilance. Milton Friedman's monetarism. If the Fed maintains tight policy, Friedman would argue that money growth remains the ultimate driver of nominal asset prices. Bitcoin, as an asset with a capped supply, suffers when indirect liquidity dries up. Keynesian sentiment. John Maynard Keynes taught us that even if fundamentals improve, markets can remain irrational longer than you can stay solvent. Mere talk of a rate cut, without concrete policy shifts, won't suffice to spark a new bull run. Darren Esimoglu on institutions. Stable, predictable policy is as important as the stance itself. Any hint of Fed independence being compromised, say, through political meddling, would spook markets, not please them. For BTC to regain its luster, the Fed must tilt toward dovishness. That means either cutting the federal funds rate or, at minimum, pivoting its forward guidance to entertain cuts by late Q3. Investors will scour every FOMC statement, DO2 plot update, and speech by Powell for signals. Even a modest shift in language from restrictive to less restrictive could unleash a torrent of rate-sensitive flows back into risk assets, including Bitcoin. 4. Long-term holders, the bedrock of the rally. One of the most encouraging developments comes from the cohort that matters most in a bull run: long-term holders, LTHs. CryptoQuant's data shows that LTH supply swelled by 800,000 BTC over the past 30 days, surpassing the 750,000 BTC threshold that preceded the July 2021 and September 2024 rallies. History suggests that when this supply metric moves above that inflection point, a powerful rally often follows. Nassim Taleb's anti-fragility. Bitcoin thrives in disorder. These long-held coins remain undisturbed through volatility, providing a shock absorber against panic selling. The more LTH supply grows, the more antifragile the market becomes able to absorb shocks and emerge stronger. Jane Jacobs on community resilience. Just as she showed cities flourish when local networks deepen, so too does Bitcoin's ecosystem strengthen when hodlers commit over years. Their holding behavior creates a foundation for price stability and a launchpad for rallies. Vaclav Smil on exponential curves. Adoption and accumulation follow logistic curves, slow at first, then rapid. The recent surge in LTH supply could mark the inflection where exponential growth in locked-up coins accelerates scarcity. Key metric: the ratio of LTH supply to total supply. As it climbs above historical peaks, it signals fewer coins available for sale, tightening the float and priming price for a significant move. 5. Short-term holders, absorbing corrections. While LTHs form the base, short-term holders, STHs, provide dynamic liquidity. Today, STHs hold at an average cost basis below $100,000, offering a natural cushion in a correction. As Milton Friedman would posit, flexible supply, in this case, monetarily through holdings, can stabilize prices when imbalances emerge. Behavioral triggers. Daniel Kahneman's prospect theory reminds us that STHs are disposed to sell into losses more readily than hold into gains. If price dips into the $93,000, $98,000 pain zone, STH capitulation could flood the market and amplify declines. Support zone vigilance. Glassnode marks $93,000, $98,000 as critical support. If BTC never visits that zone, or if visits are brief and shallow, it will confirm that buyers, both LTHs and fresh entrants, are defending price aggressively. Microstructure effects. Amy Webb's work on pattern recognition in technology cycles suggests that short-term speculators often form trading clusters at technical floors. A swift bounce from $93,000 could trap shorts and trigger a short squeeze rally. STHs will be the first to deploy their coins into the market when fear rises. If they hold firm, selling pressure will be blunted. If they crack, a retest of $90,000 or lower becomes possible, undermining a breakout attempt. Monitoring ETH realized price and exchange net flows will give an early warning of capitulation risk. 6. Network effects and real-world adoption. Beyond charts and chains, Bitcoin's ascent to a new ATH depends on expanding its ecosystem. Decentralized finance, DeFi growth. Don Tapscott has chronicled how tokenized protocols catalyze new financial primitives. A surge in DeFi TVL, especially in BTC-pegged vaults or cross-chain bridges, would demonstrate fresh utility and attract institutional credit desks. Micro and macro payments. Parag Khanna emphasizes that financial inclusion and cross-border flows drive GDP gains. Wider adoption of BTC for remittances, micropayments, or even corporate treasuries could underpin structural demand. Regulatory clarity. Mariana Mazzucato argues that public-private collaboration sparks innovation. Clear rules of the road, whether through a U.S. ETF approval or defined tax treatment, would unlock trillions in locked-up capital, from pension funds to sovereign wealth. When Bitcoin's network effects reach a critical mass measured by active nodes, DeFi integration, corporate treasury adoption, and institutional custody inflows, a self-reinforcing cycle of utility and price appreciation can kick in. 7. Narrative and market psychology. No asset thrives on fundamentals alone. A compelling narrative is equally vital. Keynes called it the beauty contest, where investors pick winners based on what they think others will value. Today's storylines include Bitcoin as inflation insurance. With persistent PCE readings above target, Bitcoin's narrative as a hedge against currency debasement gains potency, echoing Friedman's thesis on the dangers of fiat expansion. Digital gold meets digital reserve asset. Klaus Schwab and Yuval Noah Harari both foresee a world where digital natives prize cryptographic scarcity as much as physical bullion. If major central banks begin research into digital reserves, Bitcoin's symbolic role is magnified. Antifragile money in a fragile world. In Nassim Taleb's view, systems that benefit from disorder outperform brittle ones. Bitcoin's record through geopolitical shocks, from pandemics to invasions, positions it as the ultimate antifragile asset. Crafting and amplifying these narratives through thought leaders, media, and social channels will galvanize both retail and institutional flows toward BTC, turning a technical breakout into a full-blown parabolic climb. 8. Scenario roadmap. Convergence toward a new ATH. To synthesize, Bitcoin needs a four-pronged convergence before it can sustainably top $115,000 and challenge its all-time high of around $120,000. Technical breakout. A daily close above $109,000, confirmed by volume surges and retests becoming new support. On-chain revival. Meaningful upticks in active addresses, large value transactions, DeFi TVL, and reactivation of dormant supply signaling renewed demand. Dovish Fed tilt. Clear forward guidance shift by the FOMC with rate cut language or actual easing by late Q3, unlocking risk asset flows. Holdership dynamics. LTH supply extending past historical peaks, while STHs defend the $93,000, $98,000 zone, ensuring few sellers remain to pressure price. If all four align in concert, Schumpeter's creative destruction will yield a self-reinforcing surge. Taleb's anti-fragility will attract capital in search of disorder benefits, and Keynes's animal spirits will flood back into the market. 9. Risks and contingencies. Of course, nothing is guaranteed. Macroeconomic surprises. A Fed hawkish surprise, say, a tweak upward in projections, could snuff out the narrative of easing. Geopolitical flashpoints. Ian Bremmer warns that systemic shocks from China-used tensions to energy crises can override technicals and chains. Regulatory backlash. A hostile crackdown or capital control regime targeting crypto could derail adoption momentum. Market dilution. Emergence of a compelling Bitcoin killer or sudden exodus into new digital asset paradigms may siphon liquidity. Sophisticated investors will hedge these risks with options, structured products, and dynamic position sizing. Yet each new contingency can also reinforce Bitcoin's narrative as a robust, decentralized asset, increasing its relative appeal. 10. Conclusion. The race against time. We stand now at a pivotal juncture. Bitcoin's price trajectory over the next 2 months will hinge on the interplay of human psychology, macro policy, network utility, and technical market structure. As Keynes might have noted, markets can remain irrational longer than you can remain solvent, but they also can pivot swiftly when catalysts align. Friedman would remind us that money supply and policy regimes drive nominal asset trends. Taleb would celebrate Bitcoin's capacity to thrive in chaos. Mazzucato would urge us to build the collaborative frameworks that drive innovation. And Acemoglu would warn that institutions must adapt if they are to sustain growth. For Bitcoin to crest its previous zenith before Q3 2025, it must marshal all these forces in harmony: a break above $109,000, a resurgence of on-chain demand, a Fed pivot to easing, and the dual support of long-term and short-term holders. If this confluence arrives, we will witness not just a new price milestone, but a historic reaffirmation of Bitcoin's role as a catalyst for financial evolution. And if it falters, we will learn anew that even the most resilient systems require fertile ground in which to flourish. Either way, the coming weeks will write the next chapter in Bitcoin's extraordinary saga. 1. Defined by the wisdom of economic giants, the conviction of hodlers, and the unpredictable alchemy of market forces. Watch closely, for this may be the most consequential crucible of BTC's young history.